This video will explain the basics of PnL in cryptocurrency trading, including key terms, calculation methods, and associated tools. MTM refers to the process of valuing an asset or financial instrument based on its current market price or fair value. For example, in the context of crypto trading, if an investor holds a certain amount of Bitcoin, the value of that Bitcoin will fluctuate based on the current market price. Suppose the MTM price for Ether today is $1,970, while the MTM price yesterday was $1,950. In this case, the PnL is $20. It indicates a profit of $20. On the contrary, if the MTM price of Ether was $1,980 yesterday, it indicates a loss of $10. Future value indicates the value of a digital coin at a future point in time. For example, if a trader stakes Tron worth $1,000 with a 4% yearly reward, how much will the person get back after a year? The answer is $1,040. At the time of staking, the present value will be $1,000, while the future value will be $1,040. There is a different way to use future value as well. Traders could ask how much to stake to get $1,040 in a year. If they know the present and future values, they could calculate the discount factor. The formula for calculating the discount factor. Realized PnL is calculated after traders have closed their position. Only the executed price of the orders is taken into account in realized PnL, and it has no direct relation to the mark price. An example will help understand how to calculate realized PnL. If the entry price for buying X number of Polkadot is $70 and the exit price is $105, the PnL for the period is $35, which refers to a profit of $35. However, if the closing price of the trade was $55, the PnL will be $15, but it will reflect a loss. Unrealized PnL refers to the profit or loss that is currently held in open positions, but has not yet been realized through closing the position. Example: John has purchased ETH contracts with an average entry price of $1,900. The mark price of ETH is currently $1,600. The unrealized PnL for John is the difference between the average entry price and the mark price. The FIFO method requires the seller to use the price of the asset from when it was first bought. Here is the process to calculate PnL using the FIFO method. 1. To settle on the initial cost of the cryptocurrency, multiply the purchase price per unit by the number of units sold. 2. To determine the current market value of the asset disposed of, multiply the current market price per unit by the number of units sold. 3. To find the PnL, deduct the initial cost from the current market value. The LIFO method requires the seller to use the most recent purchase price of an asset in the calculation. The other aspects are just like the FIFO method. The weighted average cost method requires traders to determine the average cost of all units of a digital currency in their portfolio to arrive at the initial cost. Here are the steps to calculate PnL using this method. 1. Determine the total cost of all units of the cryptocurrency. Multiply the purchase price per unit for each transaction by the number of units of the asset and add the numbers. 2. To arrive at the weighted average cost per unit of the digital coin, divide the total cost of all units by the number of units. 3. Find the current market value of the cryptocurrency sold. Multiply the current market price per unit by the number of units sold. 4. To determine PnL, subtract the average cost per unit from the current market value. Analyzing open and closed positions at regular intervals is an efficient way to monitor performance. An initial purchase a person makes in the market is an open position, while selling the cryptocurrency is termed closing the position. If a trader buys 10 DOT, it is an open position. When the trader sells those DOT, the position gets closed. YTD is a way to measure the performance of investments made in cryptocurrency from the start of the year to the current date. Investors who regularly buy and hold cryptocurrencies for years can know their unrealized profits with a YTD calculation. The trader just needs to calculate the value of the portfolio at the beginning and end of a year and compare these values. This could be a calendar year or fiscal year, depending on the person's preference or requirements. A transaction-based calculation requires a person to calculate the PnL for each specific transaction. For instance, if a person bought one ETH for $1,000 and sold it for $1,500, the PnL for the transaction would be $500 profit, $1,500 to $1,000. If the number of transactions is small and a trader needs to calculate PnL for these transactions separately, a transaction-based calculation is an ideal method. The percentage profit method reflects the PnL as a percentage of the initial cost. An example will help understand better. Suppose a trader buys one Binance coin for $300 and sells it for $390. In this case, the person's PnL would be $90 profit, $390 to $300. To arrive at the percentage profit, the trader needs to divide the PnL by the purchase price and multiply the amount by $190/$300 x 100. This amounts to 30%. Understanding crypto PnL helps people know if their cryptocurrency portfolio is in profit or in loss. Gaining an insight into key parameters like cost basis, quantity, price of each trade and profitability of the portfolio helps traders assess the efficiency of their strategies and make necessary adjustments. Precise knowledge of the funds they have made or lost on a particular trade influences their upcoming trading decisions for the better.